What if I told you there's a way to grow your money steadily without spending hours analyzing the stock market, without taking risky bets, and without needing to be a financial expert? A way where your money can quietly compound over time, almost like it has a life of its own. Sounds too good to be true? That's exactly why so many beginners overlook it, and why those who discover it early can set themselves up for a lifetime of financial freedom. That secret is investing in index funds. An index fund is like a basket filled with hundreds or even thousands of different stocks at once. Think of it as a shortcut to owning pieces of the biggest, most successful companies in the world without having to pick them individually. For example, an S&P 500 index fund gives you a slice of 500 of America's largest companies, all in one single investment. You're spreading your risk while riding the wave of long-term growth. Why is this so powerful? Because you don't have to be a genius to make money from the stock market. You're not trying to time the market or predict which company will explode next. Instead, you're relying on the proven principle that over the long term, markets tend to rise. And while there will be bumps along the way, your investment grows steadily if you stay consistent and patient. But here's a question for you. If you had a tool that could let you invest in hundreds of companies at once without the stress of choosing individual stocks, would you use it? Drop your answer in the comments. I'm genuinely curious to see what you think. Let's break it down step by step so you can start investing in index funds today, even if you know nothing about the stock market. Step 1 is understanding your goals. Why are you investing? Are you looking to save for retirement 20 or 30 years from now? Or do you want to grow your money faster for a big purchase, like a home? Your goal will determine how much risk you can take and which index funds might be best for you. Step 2 is choosing the right type of account. Most beginners use brokerage accounts or retirement accounts like a 401k or an IRA. A regular brokerage account is flexible. You can deposit or withdraw money whenever you want. A retirement account comes with tax benefits, but your money is usually locked until retirement. Understanding the difference can save you a lot of money in taxes and penalties. Step 3 is deciding how much to invest. The good news? You don't need thousands of dollars to start. Many index funds allow you to start with as little as $50 or $100. The key is consistency. Even small, regular contributions can grow significantly over time thanks to a magical concept called compounding. Compounding means your money earns money, and then that earned money earns more money. Over years and decades, this effect can turn modest investments into substantial wealth. Step 4 is selecting the index fund. The most popular is the S&P 500, but there are many others, including total stock market funds, international stock funds, and bond index funds. A total stock market fund gives you exposure to almost every publicly traded company in the U.S., not just the biggest ones. International funds give you a slice of companies around the world. Bonds are safer but grow slower. They're good for balancing risk. Here's a question to think about. Would you rather invest in one or two companies and hope they succeed, or spread your money across hundreds and watch it grow steadily? Drop your thoughts in the comments. I'd love to see your perspective. Step 5 is setting up automatic contributions. One of the easiest ways to build wealth is by paying yourself first. Schedule a fixed amount of money to go into your index fund every month. You'll buy more shares when prices are low and fewer shares when prices are high, a strategy called dollar cost averaging. Over time, this smooths out market ups and downs and reduces stress about timing the market perfectly. Step 6 is staying patient. Index fund investing is not about quick wins or getting rich overnight. It's about long-term growth. The market will go up and down, sometimes dramatically. But history shows that if you stay invested for 10, 20, or 30 years, your money has a strong chance of growing significantly. And here's a thought-provoking question. If you knew that staying invested could potentially double or triple your money in 20 years, would you have the patience to stick it out? Let me know in the comments. Now, here's a little insider tip. Keep your costs low. Index funds are popular partly because they have very low fees compared to actively managed funds. High fees can quietly eat into your returns over decades. Look for funds with an expense ratio under 0.2%. It might not sound like much, but over time, it makes a huge difference. At this point, if you're finding this helpful, don't forget to like, subscribe, and share this video for more amazing content. And here's something fun. If you've ever wondered whether it's better to pick individual stocks or stick to index funds, drop your answer in the comment section. I promise to read every single one. Another powerful reason people love index funds is diversification. When you invest in hundreds of companies at once, a few bad performers won't destroy your investment. Your risk is spread out, like carrying multiple umbrellas in a storm instead of relying on just one. And the best part? You don't have to constantly monitor the market or stress about each company's quarterly report. Let's talk about mindset. One of the biggest mistakes beginners make is panicking during market dips. You might see the news screaming about a market crash and feel the urge to sell. But here's the truth. Downturns are normal. They are opportunities to buy more at lower prices. Think of it like planting seeds in the fall. You may not see growth immediately, but come spring, your garden thrives. Another question for you. If the market dropped 20% tomorrow, would you sell out of fear or buy more while prices are low? Drop your answer below. I'd love to see your strategy. Finally, remember that investing in index funds is a long-term game. It's not exciting in the short term, but its power compounds quietly, steadily, and reliably. By starting now, staying consistent, keeping costs low, and being patient, you can turn small monthly contributions into significant wealth over decades. So, take action today. Open an account, pick an index fund, set up automatic contributions, and let compounding do its magic. And remember, share your thoughts in the comments. Which index fund would you start with if you could invest today? Are you Team S&P 500, total stock market, or something else entirely? Investing doesn't have to be scary or complicated. With index funds, anyone, yes, even you, can start building financial freedom one step at a time. The earlier you start, the more powerful compounding becomes. And who knows? In 20 or 30 years, you could be sitting back, watching your money grow while living the life you've always wanted, all because you made a simple, smart choice today.